Welcome back to UBRI Connect. I hope you all had a nice break. I had a chance to take a good stretch, and I really missed breaking bread with you, but I really appreciate all the notes and feedback you've been sending. It means a lot to us to know how your experience is going and what you're getting out of this. So we have some more thought-provoking content for you, including some interesting academic research with a crypto focus. Before we get started on that, I wanted to see if you've had time to poke around in the platform. On the left nav bar, there's a button that says Expo. We've parked some UBRI partner books in there, featured authors that have written about blockchain, cryptocurrency, and fintech. If we've missed anyone, please let me know. We'd like a chance to promote you, as well as the new UBRI podcast all about blockchain that features you guys building real use cases on blockchain. Check it out. So first up, we have a fireside chat on stablecoins featuring UC Berkeley's Rich Lyons, interviewed by Ripple's Michael Zakowski. We'll then continue with a presentation from Professor Peter Adrians on blockchain tokenization to finance smart infrastructure systems. Then we'll learn more about how blogging relates to the price of Bitcoin with Professor Eric Geisels. We'll take a segue into how blockchain technology plays a role in health impact labs featuring Dr. Verena Kaloff, Kwang-Ho Lee, and Hyun-Sik Yoon. Gustavo Souza will then provide us some deeper analysis into the reasons for Bitcoin's volatility. He'll be followed by Wojciech Golab, who will give us a technical breakdown of data transmission and WANs, and then Yingju Li will be presenting on blockchain rewriting. Don't forget to keep engaging throughout the day in the chat. That's where your presenters are going to get your questions for each of the sessions. Enjoy the show. Rich, Michael, take it away.
All right, hello everyone. This is Michael Zakowski speaking. I am the head of product at RippleX, which is the division of Ripple that focuses on promoting services and tools and a platform for developers for the XRP community. And I'm very happy to be joined here today by Rich Lyons. Rich is a professor of economics and finance at the Haas School of Business at California, Berkeley. Former dean of the school, and as of January of this year, the first chief innovation entrepreneurship officer at the University of California, Berkeley. So very happy to be joined here. And since we only have 30 minutes, I want to dive right into the meat of the discussion here. But before we do that, Rich, do you want to give a quick background on some of the research interests that you've done and touch upon as it relates to the crypto and blockchain space?
Sure, happy to, Michael, and thanks for the opportunity to be part of this remarkable conference. So real quickly, my background, I mean, my colleagues in the academic world would call me an exchange rate economist. I actually did a lot of work over decades on what in finance they call market microstructure. How are foreign exchange markets organized? How do they trade? Where do prices come from out of the trading process? And what do we learn about how markets absorb information by watching trading? So that's really what I did a lot of work on. I got out of graduate school in the late 1980s, and a lot of the trading at that time in the major currency markets, dollar Deutsche Mark, it was the Deutsche Mark at the time, or dollar pound, dollar yen, they were just starting to trade on electronic platforms. So we had a lot of electronic data that we could look at. It was in some sense, you know, before that electronic data, before the data were available, it's like you're a biologist without, in a world without microscopes, and somebody hands you a microscope and says, wow, check this out. And it was just fascinating and lots of fun back then. So now today, I am interested, as are a lot of people, and my co-author, Ganesh Viswanathan Natraj, and I were looking at stablecoins per se. And I think our interest was, look, if you've been teaching international finance as long as I have, you've taught fixed versus floating exchange rates for decades. And a stablecoin is a fixed exchange rate. So that's looking at it through the eyes of an international economist, an exchange rate economist. those are the natural eyes or lens that I look at it through. So that was our starting point on some of our recent research.
Excellent. So, Rich, I know you are an academic, but let me just set the stage a little bit here for the conversation and some of the stakes that we're talking about. So, stablecoins have been around for quite a while in the space. I think XRP Ledger has had them as functionality for well over 7 years. Tether really started gaining traction maybe 6 years ago. But recently, they've really exploded in popularity and traction. And I think the latest number that I saw is well over $20 billion distributed amongst a number of different stablecoins, whether they're algorithmic or fully fiat-backed. And really the leader in the space is Tether, but others are catching ground. But it appears, I think it's fair to say, that stablecoins are here to stay. So I think research topic that you've been diving into over the past year and a half, I think is particularly relevant here. I think a lot of people are very interested in it. So without further ado, why don't we dive into the paper that you've written here. And it's really a fascinating paper, a ton of interesting aspects that you touch on here. But the title is What Keeps Stablecoins Stable? So before we hop into the specific points here of the paper, why don't we cut to the chase? What is it that makes the stablecoins that you were looking at stable?
Well, arbitrage in a word. If you wanted the one sentence answer, it is, the mechanism looks a lot like what keeps exchange traded funds trading at their net asset value, their NAV, the arbitrage process. Now, we wanted to look at it much more deeply and understand how that arbitrage process changes over time and what determines its effectiveness. But that's the punchline, arbitrage.
Excellent. Yeah, and I think ex post that might be a relatively clear statement here, but I think it very much is an open question, or was when stablecoins were launched, whether or not they'd be able to maintain these pegs in an efficient manner. And so this is, obviously really getting to the heart of the issue. So why don't we dive into some of the things that you looked at in the paper? I think most of the paper here really focused on USDT from April 2017 to this year. So that was the data that you're looking at. And in that period, there was a really interesting natural experiment where Tether was originally on Omni, which is a layer on top of Bitcoin. And subsequently, they have expanded to a number of different networks and chains out there. Among them, Ethereum, I think, has really gotten the bulk of the volume here. And so what are you able to glean from this sort of side-by-side comparison?
Yeah, thanks for that. I think it helped us gain some insights into how that arbitrage mechanism works. I mean, at some level, somebody could say, okay, it works via arbitrage. We kind of knew that's the way it worked, but we wanted to understand in a little bit more detail. Here's one example. If you ask me, what are the main takeaways from the paper? I think there are 5 or so of them, but here's one of them. How much money is made by arbitrageurs? The players who are doing the arbitrage, just to be clear so people understand. So suppose Tether is trading at a premium. It's trading at over $1, a penny over or 2 pennies over, whatever. And, I can go to the Tether treasury, buy 1 unit of Tether for $1, and then go into the secondary market and sell it for $1.02. I make 2% or 2 cents on each dollar that I do that with. And obviously I could do that with multiple. So that's the kind of arbitrage that is working here. And if you said, well, how much money, all those arbitrage transactions, those trades with the treasury, how much money is made per year? About $10 million, per year. And anyway, so that's one of the things that we understood. Now, your question, real quickly, I'll answer your question because you talked about the move to the Ethereum blockchain. The question then is, when you move to the Ethereum blockchain, and what was happening at the same time is that more and more wallets, more and more participants in the market got direct access to the Tether treasury. So initially, for those of you that know what an authorized participant is in an exchange traded fund market, these are effectively people who have arbitrage player status in the market. They've got a privileged position to actually run the arbitrage. And in the more democratized access to the Tether treasury that occurred in the Ethereum blockchain, the question is, did the gaps between the Tether peg at 1-to-1, did those gaps shrink? Did the half-life, the amount of time it takes to get back to 1, did that shrink when it went on to the Ethereum blockchain? And we found that both of those things are true. The half-life was cut about in half, and the size of the sort of standard deviation of the gaps between the parity price of 1 and whatever the market price was cut roughly in half as well.
Yeah, really interesting that you're able to get the before and after control there, sort of a unique experiment. I want to double click just very quickly here in terms of the data. And one of the amazing things, I think, perhaps from an academic perspective, as well as a number of other ways, is how open a lot of the data is in the space. Now, I think you were using a combination of on-chain data as well as exchange data, but can you just give a brief overview of what the data is that you were looking at and how you're able to arrive at these conclusions?
Yeah, great. Well, Coin API, and there are many other databases that many people on this or in this conference are familiar with, many of them publicly available, sometimes at a price from one vendor or another. But let me give you a sense. I mentioned that, well, how much money is made by arbitrageurs? About $10 million a year. It's sort of like, well, how do you calculate something like that, right? Well, we actually have all of the transactions between, so let's take, once Tether starts trading on the Ethereum or is processed on the Ethereum blockchain, we have all of those transactions between wallets and the Tether treasury. We also have a timestamp, so we know exactly when they happen. Now, those transactions would be happening at a parity value, right? One unit of Tether per, $1 US. Because we have a timestamp and we also have high frequency price data, we know exactly where the secondary market was trading at that time. So an arbitrage, now we don't see every transaction of every arbitrageur, but the simple assumption is if Tether is trading at a premium, so $1.02, and an arbitrageur goes or a wallet goes and buys Tether from the treasury at 1-to-1, then we assume that trade is quickly unwound in the secondary market at something, at the secondary market price, in my example, $1.02, and that arbitrageur makes 2 cents for every dollar in the trade. Now, we know exactly how big the trade is. We know its timing and we know the prices and so forth. So, you could say, well, it's maybe not an exact measure. It's pretty close to an exact measure of where that's coming from. So the data are that precise, time-stamped, very high frequency price data. One of the other things that we have in these data is we know every trade has a buyer and a seller, right? So you could say, oh, a transaction took place. There was a buyer and a seller. But one of the other things that data sets like these have in them is there's a Boolean variable, yes or no variable, that says, was this a taker side buy or a taker side sell? In other words, was the aggressor in the transaction, the person that's reaching into a limit order book or reaching into the liquidity of a dealer, is that person who's initiating the transaction a buyer or a seller? And in terms of the information economics of how markets find price, knowing who initiated the transaction is actually very important for trying to distill what information was in the trade.
They're really fascinating. I think obviously traditional financial markets also have a massive amount of data, but it is amazing that you're able to really see underneath the hood with how everything is minted. And this is true for Tether. It's true for all the other fiat-backed stablecoins, as well as certainly the algorithmic ones. So I think we've touched on a few of the main points already from the paper here, namely that arbitrage, the flows tend to have stabilizing effects on Tether price. Trades tend to be, as you just touched on, in the direction that arbitrage would predict here with the taker-maker functionality or granularity that you're able to see. And I guess that's probably the intuitive response that people would have, but many, I think, out specifically with Tether, broadly in the academic community, have somewhat questions in the past what exactly the new flows and issuances of Tether are used for. Namely, a few papers have come out, one notable one by Griffin and Chams that made the claim that new issuances of Tether were used to inflate Bitcoin prices. And this made a huge splash. I think most people following financial news in one way or another probably saw an article or two about this at minimum. And they were looking at 2017 to 2018, so a partially overlapping period with your paper here. Now, I think they were looking at wallet level data. You were taking a bit of a different lens. Can you, explain what you were able to glean from the top-down data here, and any conclusions you could draw from the Tether issuance here vis-a-vis market impact?
Sure. So when thinking about, you mentioned Griffin and Chams and other work that's focused on wallet level stuff, we were looking at much more kind of macroeconomics. Does the Treasury, kind of the equivalent of the central bank, does it adjust supply in order to keep prices close to where they need to be? Is it out there sort of aggressively managing supply? That's kind of a central bank or fixed exchange rate view of the world. Or is this arbitrage, this kind of demand-driven arbitrageurs are driving the trades, and the Tether Treasury is accommodating those arbitrage trades, but it's the arbitrage process that's setting prices. And I mentioned before, it's more of the arbitrage process. That's different than saying, no, that supply process is really driving the game in terms of keeping the Tether price stable. And of course, in the Griffin and Chams perspective, the idea that it could also be affecting a price in a very related cryptocurrency market, namely the Bitcoin market. So it's actually, some of the people in this conference would know this, but more than half of the trades in Bitcoin have Tether on the other side. So Tether is a really important transaction vehicle for the trading of Bitcoin more generally. But the punchline of our paper is this. Look, we want to look at the Bitcoin price and see whether aggregate changes in supply, so not this wallet or that wallet's trading, but aggregated changes in supply, the supply of Tether in the marketplace, not the supply of Tether on the Treasury balance sheet, but the supply of Tether in the marketplace. Did that have an effect on the Bitcoin price when you control for past prices and other things in the Bitcoin market? And we found, no, it doesn't. That when you control things that are very natural to control for in financial markets, and you look at the aggregate supply process of Tether, we find no effect on the Bitcoin price. That doesn't mean that what Griffin and Chams looked at and found is not statistically relevant, but it does cast doubt on whether this aggregate process, right? I think for some people who read that earlier literature, the idea is, oh my gosh, this whole Tether Treasury supply process is all about manipulating the Bitcoin price. And our paper is not consistent with that view.
Yeah, it's a super interesting question. I think obviously there have been questions in the past whether or not Tether is fully backed, and that certainly has implications on the price of Tether, and certainly could have implications on the price of Bitcoin. But I'll say you're certainly not alone there. I think there's been very mixed results. Wang Wei, I believe, had a similar paper with a conclusion that it did not impact subsequent Tether issuance, that is, not subsequently impact Bitcoin returns. So not alone there, but it's really interesting to see that macro top-down view. Because I think certainly with the grounding in traditional currency analysis.
Could I offer one quick thought, Michael, on in terms of how we control for various things? I just wanted to add this because those empiricists in the audience, I think, will find this helpful. We said earlier that the move to the Ethereum blockchain sort of increased the efficiency or effectiveness of this arbitrage process, that the half-life of the gaps from the secondary market price and the parity of one were cut in half, for example. But of course, the Ethereum blockchain period was strictly after in time, the Omni time period. So there could be other confounding factors, right? Well, maybe something else that happened in that later part of the sample is what shrank those half-lives and shrank those gaps, the departures in price from parity. So what we also did is we said, well, let's also look at True USD or 4 or 5 DAI. We looked at 4 or 5, 6 other stable coins, and then we asked the question: look, it may be that all of them were trading closer to parity in the after period, but do we find statistically significant evidence that the gaps, the pricing gaps in the Tether case fell by even more than that collection of other stable coins? In other words, we're sort of controlling for time, and by controlling for these other stable coins. And we find that it is really quite significant. So this interpretation that it's really about the democratization of access to the arbitrage process on the Ethereum blockchain is what's driving that collapsing of the price gaps to parity.
Yeah, a super powerful concept, I think. It certainly ties in a lot of the themes that have been touched on throughout the day and yesterday here. So I want to dive a little bit deeper into what happens when the price diverges from parity. I think we've discussed the arbitrage normal case scenario here, but there are a few different instances. And before we, I guess, touch on some of the more fundamental framework that you put into place in the paper, there's a super interesting case study here about the Tether speculative attack in October 2018. So do you mind explaining the context of that attack around whether or not Tether's collateralized and what you're able to glean from that specific event?
Yeah, well, I mean, it's true in general with this category of stablecoins, right? Is that people want to know not just is something 100% collateralized, but is it collateralized with super liquid stuff? In other words, could I get it instantaneously? What does the balance sheet, what does the portfolio look like, right? We could say something's 100% collateralized and have some of our holdings in less liquid assets, and that means, look, it's not instantly available the way a demand deposit at a bank would be, right? So that's part of the question. It's not just about 100% collateralized, i.e., is it solvent? Part of it is about, is it completely liquid? And that was, I think at the time, really what a lot of the market wanted to know, is just how liquid is this? As anybody who did reading at the time, there were audits that were done and discussion of what that balance sheet looked like. And is it cash or near cash equivalents? Are there loans? A loan is not a particularly liquid asset. And it came to light that there were in fact some loans in that collateralization. There was a period of suspension of redemptions that created quite a bit of havoc. In our paper, the largest discount, the single large, of course, this is not a lot of trades went off at this discount, but I think it was roughly 9.5% discount is the maximum in that super stress crisis period for Tether, and nothing anywhere near that large has opened up since then. But it was effectively a speculative attack, and speculative attack is a term of art we use all the time in exchange rate economics, right? So the idea that you've got a central bank that's trying to hold the line on a fixed exchange rate, and the hedge funds are putting on short positions, and the central bank wants to make those short positions expensive, so it raises interest rates. Raising interest rates puts pressure on the economy starts tanking, and the hedge funds, look at that central bank and think, yeah, they're not going to be able to leave interest rates that high for very long. This is going to crash. Sometimes there's a whole literature on so-called self-fulfilling collapse models where the fundamentals weren't necessarily inconsistent with a fixed exchange rate, but the whole model collapses in any event. So that kind of logic of multiple equilibria is something that exchange rate economists naturally bring as a set of lenses when thinking about stable coins, and whether, the question isn't just, is this almost always trading at one, or is this portfolio almost always liquid? That's actually not the question. I'm not just talking about Tether. I'm talking more broadly, right? It's sort of like, no, it's sort of like in the 1 out of 500 days when the market is at its greatest stress, is that collateral portfolio liquid? Is that arbitrage mechanism going to work? And, so when we think about international financial institutions, a Bretton Woods system and some of the other things, they're trying to design these things for decades. It's like you have to find like the worst day in 3 decades and make sure that it's robust to that. And I think it's still safe to say that we haven't had sort of the 3-decade high water marks in some of these markets. Not to say that they're going to collapse, but I think people are watching very closely. What does this look like on the most stressful day we could imagine?
Yeah, it's a super interesting question, and I think certainly a lot of parallels between traditional markets, sort of shades of George Soros breaking the Bank of England and being able to push a peg in a direction that you think that the bank can't defend. And it brings up an interesting point here in your paper. You note that from first principles, because of that risk, that whoever's managing the treasury would somehow fail or mismanage the treasury. And this is true even in a stablecoin where you do have high conviction that it's fully one-to-one backed. Normally, you would expect that to trade below par to account for that risk. But we've seen a number of instances where the stablecoins are actually trading well above par.
Yep.
What do you make of that?
Well, so, that's an interesting phenomenon, because I think when you go into the fixed exchange rate world, when you've got a pegged exchange rate and people feel it's overvalued, the pressure is always down. It's like, is there going to be a devaluation? Is there going to be a devaluation? It doesn't sort of want to trade above its parity, right? It wants to trade down below. And so it's very one-sided in terms of the distribution. For market practitioners who've seen the data, this is familiar to you. But one of the things we wanted to document in our paper, that it's really quite a two-sided distribution, right? That you've got a lot of periods where Tether and other stablecoins are trading at premiums, i.e. above $1 for those pegged to the dollar. And sometimes at discounts as well. And so I think on the premium side, part of it is, it's sort of like, well, why would anybody trade? Why would anybody buy something at a premium when you can buy it from the Tether treasury at 1, right? That would be one of the questions. Now, in a period where I'm not one of these authorized participants in the sort of earlier and omni blockchain period, where there's less democratized access to the treasury, then you would have to go into the secondary market. Now you might say, but still, why would you buy it at $1.01 or $1.02 if you kind of know that the right value is 1, and that the half-life of getting back to 1 is like 6 days? Why don't you just wait? And I think the idea is there's an immediacy value. Somebody says, yeah, I think I'll actually give up 1%. I expect to give up 1% in the next day or 2. But it is so valuable for me to get out of Bitcoin, for example, right now, and into something relatively stable, that even though it might cost me 1% on average over the next week or month, it's like, I'm willing to do the trade. And I need within that crypto asset economy, I need to get to a safe haven, and this is my best option. So here I go, pull the trigger. So that it's a convenience yield is one way to think about it. It's a value that people are willing to pay for, even though they know that it's going to cost them a little bit on average.
Yeah, you touched on convenience yield. It's a super interesting topic, and I think it generalizes perhaps more broadly in the crypto space, where you see often people taking in the abstract uneconomic positions, but perhaps in taking account their entire utility function or preferences makes sense. So really interesting phenomenon to observe. You also note here that the Tether order flow here, you can certainly take a technical lens as well, but it can be quite robust here. I think you arrived at a 40 million in net order flows to change the price of Tether by 1% here. I guess very briefly in our remaining 2 minutes here, how much of an impact do you think these sort of more technical phenomenon have in these markets and will continue going forward compared to the more fundamental drivers that we've touched on?
Yeah, well, the word technical, of course, is a term of art in finance. When we talk about charting and things like that, it has certain associations. But I'm going to take the meaning of your question to be a little broader. That sort of technical portfolio shifts, these portfolio shifts not otherwise explained, that can be moving price. And one way to think about it, remember we mentioned before, I realize we have to close down now, but there's this half-life process, right? And it's let's just say it's 4 days in Tether right now. So if a premium opens up, it goes to 1.01, it doesn't disappear within an hour or even a day. On average, it takes a few days, and vice versa. If a discount opens up, it takes a few days on average, not always. So what's the title of the paper is what keeps stablecoins stable? Well, what keeps stablecoins unstable? In other words, why do they ever leave parity is the right question. And what we find in the paper, which is consistent with other financial markets, is that the arrival of these order flows, again, there's trades, there's buyers and sellers with every trade. But was this a buyer-initiated trade? Is there a string of buyer-initiated trades that are pulling liquidity out of the market? Because people look at that and say, oh my gosh, fundamentals, the price should be going up, and people move price. So they're reading the tea leaves of the signed order flow, buyer versus seller initiated. And so you could think of it as sort of a process with two components. One component is this mean reverting component, and the other part of the process is this order flow arrival that's banging it up and banging it down. And those two things are sort of in a dynamic equilibrium together.
All right, so I think we are at time here. This has been a super informative conversation. Really appreciate you being able to bring the lens and the toolkit of a traditional economist looking at foreign exchange markets and applying it really in a way that I haven't seen before. So thanks so much, Rich. The paper is, again, What Keeps Stablecoins Stable. Recommend everyone here check it out because it really is a fascinating paper, and I really enjoyed reading it. So thanks so much again, Rich.
Thanks, Michael. Cheers.
Good afternoon, everyone, and greetings from Ann Arbor. It's not quite like coming to London, but I'm very happy to be part of the second UBRI meeting. Last year's at Berkeley and now going virtual. I'm Peter Adrians. I'm at the University of Michigan. I'm co-leading the FinTech Collaboratory here, and I'll be talking a bit about smart infrastructure finance and tokenization. So let me go to my screen. So digital finance and blockchain tokenization. We're calling this a Moneyball approach to closing the infrastructure finance gap. And I'm going to talk a little bit more about that to kind of give you a sense of what this all means and why Moneyball. I'm trying to share. Some reason I can't see here. Our partners in this whole program are, aside from the Center for Smart Infrastructure Finance, the FinTech Initiative, Michigan Ross FinTech Initiative, the Center of Finance Law and Policy, and of course we have our awesome students at the Blockchain at Michigan group. And you see a couple of pictures here. The top picture is from actually an UBRI workshop that was hosted by Blockchain at Michigan at the bottom. you see our broader group meetings with the students. We have other partners in here, Blockchain Triangle, which is a blockchain company in Bermuda, Nuveen, and FactSet as well. For some reason, my slides do not advance. Apologize. When we talk about infrastructure, what do we mean? We talk about both roads and bridges and energy systems, mass transit systems, and whatnot. So it's a broad group of types of infrastructure systems. The financing of this infrastructure crosses many what we would call different asset classes. So we have social infrastructure, regulated infrastructure, and demand-based infrastructure. And the last one is the most interesting one. Because when investors look at infrastructure systems, they expect a certain return at a given risk, depending on the type of infrastructure that they're working on. So demand-based infrastructure is the infrastructure where essentially the performance of the infrastructure drives the financial returns. And what we're capable of doing with smart infrastructure, this is data-driven infrastructure, is to capture higher returns out of these infrastructure systems. So just by the numbers, I mean, in the US, we have a shortfall of about 5.4 trillion by 2030. The world has a shortfall of about 15 trillion in money that needs to be invested in infrastructure. And pension fund commitments to infrastructure are pretty limited at 5% of holdings. The challenge is that most of the projects do not meet the risk return and liquidity requirements of the available capital. In fact, the investment world has taken a look at this, and they're having these discussions around Industry 4.0 meets finance. And the whole idea is that infrastructure is starting to develop new operational models, is becoming digitized, fractionalized. We have tokenization starting to happen in infrastructure. We want to talk a little bit about what that actually means in the context of our project with Ripple. I have a short presentation.
A major transformation has taken place in infrastructure. We've integrated all sorts of data capturing devices to actually measure the performance of the infrastructure. Smart infrastructure finance is a meta-discipline that is taking advantage of the data that are produced from all these infrastructure systems and captures them into new financing models, very different from the ones that we've been using traditionally to finance our infrastructure. If you look at this, and currently how infrastructure is financed, everything is based on the tax base, the credit rating of the community that needs the infrastructure. What smart infrastructure finance does, it uncouples to some extent the financing of the infrastructure from the tax base that can pay for the infrastructure. The fact that we have data on infrastructure will allow us to actually better design and customize infrastructure systems based on the needs of specific communities. The engineer of the future will learn how to design infrastructure that is actually investable and can actually capture value for society.
So when you see a city, we see a city's data streams. And data streams mean operational savings, CapEx savings, intangible data such as co-benefits, and new derivative cash flows. So essentially, we pluck apart a hard asset into a digital asset. And what we then do with that data is we link it to efficient financing models. I mean, you're looking at a bridge, you're looking at a building, you're looking at a mass transit system, and we capture those data streams and actually look at how they can inform, for example, smart contracts, or how they can inform liquidity of an international transaction. Most of the infrastructure out there is actually financed using a wide range of international funds, international lending, international private equity. They get committed mainly
제가 그 영상을 좀 틀려고 했는데 이게 시간상 그걸
Transactive.
틀어버리면 제가 뒤쪽에 과제 설명을 거의 못하게
using
되더라고요. 그래서
the
말로
SWIFT
설명을 좀
system,
하고
and we see an opportunity here where on-demand liquidity creates an opportunity for data tokenization. So let's give you a couple of examples. One example is the blockchain-enabled Transactive grid, where basically we can now using blockchain start transacting energy across a peer-to-peer system. So there are a number of microgrids set up. This one over here is from in Brooklyn, New York, where about 40 homes are connected through a blockchain network, and the data that are energy that is produced on an output basis is bidded out and can be transacted to the remaining communities. A second application is a variable interest rate security token. This is something we're doing with Blockchain Triangle in Bermuda, where we're seeking to finance not only the transition of a diesel-powered bus system to an electric-powered bus system, but go beyond this and actually connect the bus system into the energy grid and beyond. So basically, we're keeping track of all the data in that system using smart contracts and using a payout using a variable interest rate security token. Lastly, we have value-added token financing, where we're looking at connecting the municipal bonds that are being used to invest in, for example, schools, or in roadway systems or bridges, or in water systems like the Great Lakes Water Authority, or even just in public facilities, public buildings such as in Washington, D.C. And we pay for that infrastructure using two models. The first model is the revenue from the tax base. So it is the tax money from future development that pays to service the bond. And then second, we look at revenue from tokenized added value. So we're looking at additional value of data stream and operation and maintenance of these facilities, tokenize that, and that goes back to actually pay for the capital investment. So there's sort of three different models that relate to smart infrastructure financing systems. So bringing it back to the conversation at hand. So this the Center for Smart Infrastructure Finance at the University of Michigan is the first center that we know of, in the United States, that is actually looking at capturing these various different data streams to come up with new financing models, including blockchain tokenization. And it's been an awesome ride. We've been able to work between engineering, the business school, School for Public Policy, as well as with an awesome team of blockchain students. We have a club that has about 200 to 250 students on their email roll. They're all interested in getting trained in a peer-to-peer model to contribute to all sorts of blockchain applications. Now, thank you for listening to this talk, and I apologize for any technical problems we may have had, and I'll take any questions. Thank you. All right, thank you. Thanks for listening, and look forward to attending the rest of the conference. It's been awesome. Thank you.
Good afternoon, everybody. My name is Eric Geisels. I'm very pleased to be participating in this event. I'd like to talk to you about a paper that is still work in progress. It's entitled It's entitled Bloggers and Bitcoin Prices, a textual machine learning analysis. This is joint work with one of my former students, Zhang Wen, who now at the faculty at Penn State, my colleague Donghua Shin at UNC Chapel Hill, and a postdoc funded by the University Blockchain Research Initiative, Zhou Wang. And we are grateful for that support. So unlike quote-unquote traditional assets, cryptocurrency markets don't really have information intermediaries. There are no sell-side analysts that produce earnings forecasts or make stock recommendations and the like. And also there's no real reporting requirements in cryptocurrency markets. It's not so clear how information is being transmitted across the different platforms. So what we study in this rather unique cryptocurrency environment is how individuals freely discuss their views on a well-known blog which was created by the creator of Bitcoin, actually. And we use state-of-the-art machine learning techniques to sort of capture the relationship between blogs and future returns on Bitcoin. So this is a forum called Bitcoin Talk. It was initiated by Satoshi Nakamoto, so the creator of Bitcoin. If you see on the plot here on the right, you can see that about 10% of the bloggers comprise about 80% of the actual posts. So it's a small number of bloggers who write a lot of the posts. 20% comes up to 91%. And so we sort of have the bulk of what's going on this platform by looking just at a small number of bloggers, which is kind of useful. In terms of empirical findings, we look first at what you may want to use is traditional dictionary-based models to predict future returns. That turns out to be not very useful. Next, we look at machine learning textual analysis on aggregated blocks. That doesn't work either very well. What does work is extracting for each of these individual bloggers their own relationship between what they write and future returns, because each of these bloggers have different writing styles. And we'll see that formally measured by the distance between the different dictionaries that are attached to each of these bloggers. There's a fair amount of heterogeneity in predictability, and it's kind of interesting also to see that comments that are posted that get a lot of attention by follow-ups, they tend not to be much predictive, but the ones that get less attention have more prediction content. The literature is rather sparse. This sort of literature on the wisdom of crowds, very much focused on the Seeking Alpha platform, where it's been shown that there is information that pertains to the predictability of stocks in the opinions that are written on Seeking Alpha. There's a little bit of work on cryptocurrency markets as well, but not to the degree that we're actually going to do sort of more advanced analysis of textual analysis. I don't really have too much time to talk about the actual models, but the data is fairly conventional in terms of we use Bitcoin data from Keiko in terms of 11 reputable exchanges. We volume weight those to create return series, price series, and return series. We look at ranging from 5 minutes after a blog is posted to 90 days horizons. So we look at very short as well as longer horizons predictability. We choose only key posts that have Bitcoin or BTC contain as words to sort of weed out a lot of other blogs that are not as relevant. The dictionary-based approach, which is the Logren-McDonald sentiment list of words, those really don't work very well for these blogs, for the reason that those standard dictionaries are based on financial press articles, and the writing style and the words that are used in blogs are not particularly those of professional writers that write for the financial press. So that's not going to work very well. We're going to have to sort of relate. We're going to have to use more advanced techniques for doing this. So what we do is we use this is one example of what is one would call a supervised textual analysis, supervised learning textual analysis. That is to say, we look at an article or a blog rather that is written, and we look at the subsequent returns on the Bitcoin market, and we look at the classification problem, whether these articles reflect a positive or negative sentiment, and whether the subsequent returns were either positive or negative. So this is a classification problem with a two topics model. That's about all I'm going to say. It's fairly standard once you understand what it actually means. And so we apply this to all of our bloggers. We look at a testing period of 2017, 18, 19. So these are going to be 3 genuine out-of-sample evaluations. So we train our models for data sets that start in 2014 and end in 2016. When we look at the 2017 sample, the data ends in 2017 to look at the 2018 sample, etc. So these are trained on a number of years and then tested out of sample, their performance. We look mostly at the top 10 bloggers in the sense that we look at those that get the most quoted over this sample period. In terms of the predictability of the aggregate daily posts, so we just put all the blogs into one big data set and look at predictable patterns between the words that were written in this case by a whole set of bloggers, so it's very heterogeneous, and that doesn't work very well. The correlations and Spearman correlations are very low, as you can see. So that's not going to work. When we look at the individual bloggers, so this is a little bit of statistics on the number of blogs that there are in the sample, the average length. So these are the number of words in each of these blogs. So they're kind of 41 is rather small. So these are very short messages. But there is a fair amount of heterogeneity still in terms of the number of blogs, even among the top 10. So this is just a bunch of, this is an example of positive versus negative words that come out of these classifications, supervised machine learning exercise that we do. Getting to the writing styles, this is the reason why we look at individual bloggers. One way to measure this is known as the Jacquard index. These are the words, say A are the words of one blogger, B are the words of another blogger, and you look at what is common between the bloggers in terms of words versus the union of both these word sets. And of course, if they're overlapping completely, this is 1. If there is no overlap, then this intersection is 0 and this measure is 0. So you can think about this as a little bit as a close, like a correlation. If it's very low or near 0, there's no relationship. And when it's 1, there is a perfect relationship between the two. So this is for the positive words among the 10 bloggers. And you can see that all these numbers are very low. 0.16, I guess, or 0.17. It looks to be the highest here. So they do have different words that they use that yield predictability. Same for the negative words. There is not very much relationship between the writing styles and the keywords among those different bloggers. So that's really shows us that you really want to care about what these individual bloggers actually write. In terms of the predictability, I'm looking here at the 1, 7 day, 30 days, and 90 days ahead predictability. These are again Spearman rank correlations, and now you can sort of see that we are picking up higher correlations at some horizons for some of these bloggers. These are significantly, statistically significant as well. So there are predictable patterns for some of the bloggers, and their language, their writing sets them apart from among all other bloggers. I mean, that's a fact. When you start to look at the specific blogs writing styles versus the dictionary ones that are more commonly used, you can see that this is a QPS, a quadratic probability score measure, which also, if it's high, it's good. When it's low, it's not. And you can see that these tailored dictionaries are doing better than the regular dictionaries at all horizons. So that sort of confirms that too. And last but not least, we try to combine the different predictions from all these bloggers. We do it in two ways. One is we combine each of the bloggers with actual returns data in the past. So we look at the market, how the market has been evolving, and we combine that with what the blogs has told us for blogger 1, 2, 3 through 5. And in all of these cases, the numbers here for the combined, where you look at the predictability just from the blog, this is this 0.7, just from returns, which is 0.66, and then from the combined, you see that the typical situation is that the combined is better. So there is still information beyond what is written in the blogs from the returns, and vice versa. There is returns, the information in the returns that is not in the blogs. This is at 1 day horizon and at the 7 day horizon. Last but not least, we also look at how you can combine the bloggers among themselves, and you can see basically that in this case, combining the bloggers also yields better results than just each of the individual bloggers typically. Not always, but not typically. So to conclude, this is machine learning textual analysis to find predictable patterns between social media blogs and the market for Bitcoin. There's still quite a bit of things to be done, but the results that we have so far are quite promising. We are still looking at feedbacks among the bloggers, the sort of more network connections, as well as whether we can sort of do better terms in terms of aggregation. Thank you.
Good afternoon, and thank you everyone joining us from really across the globe at this wonderful conference. We are switching gears, I believe, a little bit from some of the previous conversations that you may have been having to talk about blockchain technology in health. This is going to be a three-part presentation. I'll first talk a little bit about Blockchain and Health Impact Lab and how we develop a business model for a collaborative lab that connects research and industry before handing it over to my colleagues from Korea University to do a quick presentation on the work they've already been doing, and then we'll be happy to answer any and all of your questions related to blockchain technology in healthcare. So When we started thinking about looking at the intersection of blockchain technology and really the utility of blockchain technology in healthcare, we decided to take a step back and look at what do our stakeholders really need. And for that, we initially went in and identified our stakeholders, held a number of semi-structured interviews, and performed data analysis on the interview that we performed, and built a business model based on the answers that we received. The questions were really focused on current opportunities and gaps in research and development, as well as who the key stakeholders really are and what the stakeholder needs might be. And all of this was used to develop the value proposition and the key activities of BEAL, the Blockchain and Health Impact Lab. Based on the feedback from our interviewees, we heard that there really is much of a need for secure data transmission in healthcare. There is an opportunity for sample tracking as well as medication tracking. So when we talk about sample tracking, it's how do we track biopsies from the operating room all the way through the analytics labs and back to the medical provider with information. There's also opportunity for data coordination, and I just had a conversation with the Dean of Dell Medical School around this particular topic, where he emphasized the need not just to coordinate data between clinical enterprises, but also to be integrating data from the community in order to have more actionable data at the point of care. And then, of course, the patient ownership over healthcare data. How can I enable those who need to see my data when they need to see it, and how do I revoke this when I no longer want to share this? However, there is a lot of distrust in blockchain technology, and that may be a little bit hard to hear for many of us on this call, particularly in the healthcare environment. There are very, very few case studies that are looking at the utility, at the robustness, and the impact that blockchain can have in healthcare. And there is also a lot of risk aversion. Healthcare organizations in general don't have a whole lot of overhead when you look at the clinics as well as the hospitals, maybe a 2% profit margin. And they are dealing with individuals at their most vulnerable time and the most vulnerable data. So those are certainly some gaps and some opportunities for us to be looking at. When we looked at the different stakeholders, they were very, very diverse. Certainly the healthcare systems and the providers, but obviously the technology industry, as well as patients, patient advocates, and privacy groups, and also our faculty and student researchers. Most of them needed better and more efficient and secure tools, as well as access to unbiased information and education, although the information and education is different based on the stakeholder we're talking to. There's opportunities that technology industries are looking for to test and develop those better tools. They would like some access to key opinion leaders, as well as, of course, access to a future workforce and ideas for new development as well. The patients and patient advocates are very interested in better and more efficient and personalized care as well. And when it comes to our faculty and students, they're interested in exploring some real-world cases to develop better tools, as well as certainly in the case of our students, future career opportunities. Overall, there seemed to be a great need for an unbiased university-based lab to serve as a trusted resource on blockchain in healthcare. So when we started looking at the key activities and the value proposition that the Blockchain and Health Impact Lab at Dell Medical School could really provide, it was threefold. There's education, applied research, as well as applied innovation as huge opportunities. The education arena would provide seminars as well as workshops, and also serve as an opportunity for key opinion leaders to come together, explore the difficulties, the challenges, the ethics, the policies, and the policy changes that are required in order to use blockchain in healthcare. On the applied research side, there is an opportunity to perform case studies, grant-funded as well as industry-sponsored research that can generate high-quality, unbiased, impactful, and applied research that can then be published in peer-reviewed journals. But this also provides an opportunity for our students to engage in real-world projects, perform some networking, and have potentially access to internships. On the applied innovation side, we're partnering with the Texas Health Co-Lab, which is the innovation initiative at Dell Medical School, to help uncover some needs through brainstorming, develop the insights into the processes for those pains, for those problems in the healthcare side, and really outline the processes that are involved, that are surrounding these needs, which will then give insight into what opportunities and where blockchain could fit in. And we also have the opportunities to accelerate innovation out of the applied research through commercialization efforts, either through spinning companies out or out licensing ideas. This was just a really brief overview, and I look forward to your questions during the Q&A session, but I would like to acknowledge the funding from the University of Texas Blockchain Initiative at McCombs School of Business. If you would like to hear more about some of the work that we've already been doing, please join Anjum Khurshid in his talk tomorrow. We were also aided by Usman Muhammad and Shelby Griffin as our interns. And of course, many thanks to all who have generously offered their time, thoughts, and insights as we were developing the Blockchain and Health Impact Lab. With that, thank you for listening, and I would like to hand it over to my colleagues from Korea University. You may also contact me at these two email addresses. Looking forward to engaging further. Thank you. Oh my goodness, I just was just told that we lost our other guests. They were going to present some details on some of the work that they have been doing at Korea University. And my apologies, I'm certainly not quite as proficient talking on the subject as they would be, and I hope they can join us in a few minutes. But Korea University certainly has been having an opportunity to partner with some of the public health providers within their country, and they have a very different healthcare system than we are encountering in the United States. So they've had some opportunities that would provide different sorts of access to the individuals within their population. So I hear some clicking in the background. Have our colleagues from Korea been able to rejoin us?
Yeah, sorry for the
Okay.
sorry for technical issues. I'll just continue with my presentation. The name of the project is developing medical data exchange system and dynamic consent platform via blockchain. The reason for doing the project is that there has been needs for technology to secure the integrity of the medical data exchange system using blockchain and dynamic consent system platform that overcomes the limitations of the current consent system. So basically, we are using the many ideas to achieve such a goal. Ensuring the integrity of the patient medical data through blockchain technology is needed, and the next generation consent system is required to overcome the limitations. So the research is basically on a study on blockchain-based medical data exchange system and the dynamic consent system. First, we identified the trends of the blockchain technology within the medical data exchange system and dynamic consent system, which is currently we are processing the medical data integrity model based on distributed ledger technology and blockchain-based dynamic consent system, and we are building the basic platform. In future, we are going to we will process with the pilot test of the dynamic consent system and ensure the integrity of the medical data exchange, and it will be conducted and evaluated on actual usage. Now is the research team. All right, we are RIMA Lab, which is Risk Management Lab in Korea. So this is the lab, and We basically study ISMS, PIA, risk management, blockchain, and data analysis, and so on. The main research project that is being processed is National Security Research Institution projects and Ministry of Health and Welfare, which is all related to blockchain. And there's some interesting recent research results. If anyone is interested, just do look into it. And this is our partner, Korea University Annam Hospital. They provide us with insights and perspective of the hospital and clinical data. Korea University Annam Hospital is a part of Korea University Medicine, and it consists of Annam, Gro, Ansan, and Cheongdam, which is 4 campuses and 4 hospitals. And the informations that are on the presentation are the basic information of the KU Medicine. Okay, they made some great outputs over the years in making new attempts to proceed onto the future medicine. If anyone is interested in the hospital, I'll send you some brochure in English. This presentation basically presents that they are looking forward to the future medicine. For example, AI-based drug design and so on. So please do look into it. Now is blockchain-based medical data exchange system and dynamic consent platform projects. The key idea is development of an effective dynamic consent system framework by defining the dynamic consent system process using machine learning and consent system lifecycle specialized for medical data. And we're going to use blockchain to ensure the security of the data, medical data. So it will include federated compliance model to identify the compliance by identifying the medical environments and constraints of the medical data flow itself, and analyzing the various logs in the exchange environment. We're going to ensure that all the compliances are made and there's no problem in the related area. In order to verify our platform, there will be validation of the developed dynamic consent system by using clinical data through IRB and established system discipline plan for practical use of the developed system. And these are the steps that we will take to achieve the goal. Currently, we have achieved IRB from 1 hospital, and we are going to achieve 2 more IRBs and proceed with the validation in the future. So currently, we are developing the medical exchange system and dynamic consent platform by blockchain. The main ideas and research results are used in the process. And these, the picture is the picture of the dashboard, which is the platform that the information will be processed. And the dashboard is developed by the intelligent UI to ensure patient's usability, and it provides the flow of the personal information from the schematic perspective, and it implements an exchange system that meets the current compliance standards and allow dynamic consent through the blockchain. Okay, so if anyone has any additional questions or any comments, please do contact me through the email. And thank you very much for listening to my presentation.
Well, please do let us know if you have any questions about either one of the attempts and opportunities to really look into how can we apply blockchain technology at the intersection of the technology itself and integrating it into healthcare. We're certainly very passionate about unraveling all of those opportunities and elevating the confidence of healthcare providers in it. And I think between what my colleagues are doing at Korea University and what we're doing at Dell Medical School at UT Austin, within those 2 very different settings, I think we will have a lot of great opportunity to really develop some actionable and impactful innovation. Can you comment on some of the challenges for medical data exchange? For example, what kind of blockchain is used? Huizing, do you want to go ahead and answer that? I know you guys are really deeply involved in this work already.
So the key issue in data medical exchange system is actually keeping on with the current medical system itself. You cannot go over the current medical system and create new system because of all the vocabularies and all the system they currently have. And we are currently planning to use the public blockchains, for example, the ledgers of the open market, hyperledgers, the AW system, and so on. So it will be basically on public blockchains, and we will be using all those technologies. Off-chain.
프라이빗 블록체인이기 때문에
네.
퍼포먼스가 충분히 나오기 때문에 라지
So
스케일
is private blockchain, the performance won't be the issues. And how to the private key는 어떻게 private key는 어떻게?
프라이빗 키는 중간에 그러니까는 각 앱들은 없고 중간에 신뢰할 수 있는 뭐 닥터나 이런 사람들은
Okay, so for the private key, every personnel who use the application won't have the private key, but those who are the for example the professors or the doctors or the personnel from the administration will have the key and keeping track with all the informations in the middle. All right, thank you.
So that does bring up a really good point, though. I mean, one of the challenges when it comes to healthcare right now is the lack of interoperability. I mean, certainly in the United States, we have issues with interoperability with systems, even within some of the same healthcare institutions, where sometimes they have 7+ different electronic health records running. And so as we are developing blockchain for healthcare, we need to keep in mind that we want to improve this sort of interoperability and the ability to exchange across country. Now, at the same time, though, that will likely not just involve technology, but also a deep conversation around legal issues and around some of the laws and regulations that are in place in a variety of different countries, which opens up opportunities for all of us to work together, but at the same time, challenges that come through collaboration and through broad and ambitious goals as well. So it doesn't look like there are any further questions. We wanted to thank all of you for joining us for this talk today, and certainly look forward to connecting with you throughout the rest of the conference and afterwards. Thank you so much.
All right, thank you very much.
Thank you.
Hello everyone. So my name is Gustavo Grival, and today I'm going to present a work that I have been conducting. There is how to break Bitcoin volatility and market influence. So I'll start now sharing my slides. Okay. So our goal is a very common one, which is break Bitcoin volatility, explain how it's generated, where it comes from, and which is a question that many researchers try to find answer, but we will use a very different framework. So the volatility that we'll use will be by realized variance in a 5-minute sliding window, which is a high-frequency framework for starters, and trying to explain this volatility by some variables, which will be 2 major groups. The first one will be Forex major crosses, price and volume of each crosses, gold, oil, Hong Kong dollar, and then other cryptocurrencies. We use the 5 most traded cryptocurrencies, including Bitcoin. And over these variables, we use some transformations. These transformations will be not only past returns, but also interactions between different variables. And we will not try to predict the volatility directly. Actually, we're going to break this volatility into 4 quantiles, 9%, 80%, 7%, 6%, and having a different model for each one of these quantiles. The model that we use is XGBoost, and we'll have actually the problem of trying to explain how this model predicted the values. So for that, we use SHAP values. And now explaining a little bit on SHAP. SHAP is a very recent tool that allows you to understand for any machine learning model how it predicted some value using the variables. So basically, it makes some perturbation on the observations and other transformations, and then you can see how much the predicted value changed and the rates of this change. And then you have the relevance of each feature of your data set for each observation, how much it contributed to the prediction. So while using this approach, there is a little bit different from others using linear regression and other mostly econometrics approaches. And why using that is basically we are using a high frequency data set so we can reduce overfitting, because we want to have a very big XGBoost with a lot of layers. And then we can have also a high dimensional framework, because we used almost 300 variables. In this way, we can have very complex modeling. And also by the SHAP values, you can see the importance of each variable by each observation. Then you can see if it's changing by the beginning of your series or at the end, the relevance of each variable is different. And finishing, there is this idea of having a different model for each level of volatility. So since the model is trying to predict it will be above or below each quantile, you can see if different levels of volatility comes from different set of variables in different relevance levels. And then our results. This is for the 80% quantile. I not only ran for Bitcoin, but also for 3 other assets, Euro, Swiss franc, and gold. And then by the first line, yellow line, you can see the total amount of relevance of variables relating to its own dynamics of each currency. So in the sense, this 24% of Bitcoin is saying that for all the variables like past returns, traded volume is 24% of the total relevance of the predictions. And you can see there is a lower level than Swiss franc, the euro, and also for gold, there is no value here, because we observed that gold is one of the most unpredictable and had a lot of problems modeling, so the values were not so much restful. And then you can see that Bitcoin is not so much unpredictable as much as Swiss franc and gold, in the sense that we'll talk a little bit more later. So, and when we break this idea for each quantile, you can see for higher levels of volatility, it comes less from Bitcoin and more from other markets. And then you can see the joint cryptocurrency volatilities coming from others cryptocurrencies, and this non-crypto coming from traditional markets. And what you can reach with this study is that we can demystify this idea of Bitcoin not being so much connected to other markets in the sense of how much it is volatile. And mainly when you increase the volatility, you can see that Bitcoin is having some relation to other markets. It can be more volatile than other assets, but in a high frequency framework, we can see there is actually some sensitivity to other markets in some sense. And also, if you want to see a more isolated and less predictable volatility, you can see that gold and Swiss franc is much more unpredictable, than gold, than Bitcoin. And then just some bonus fact is that when you open those Forex crosses and also oil, you can see there is equally distributed this importance of each feature. Actually, Swiss franc is a little bit above of this importance, mainly for the highest quantile that we break it. So that now I'm gonna stop sharing my screen and I will open for a Q&A session. So, okay, why use Shapley and not compare with some models simpler like Garch? This is mostly because we wanted to use XGBoost. We even tried neural networks because we wanted to have a more powerful model in some senses. And in this way, we have a powerful model, but harder to explain. So we had to use Shapley or even Lime, but Shapley is a little bit more robust, some effects. And then we can trace back how XGBoost was trying to predict each variable, each observation. Garch, I saw a lot of papers using Garch. Some of them do not reach some importance of that, do not see some variables as significant as much as we saw in our work even. Are the quantiles conditional? No. This is something that we were even thinking. We just saw all the volatility and we break it. We even thought about breaking into the period and other way to break this quantile. Nice question. Oh, this is it. Thank you very much for watching the presentation. And any more questions, you can reach out for email any other way. Thank you very much.
Okay, I think we're live here. So I'd like to introduce myself. I'm Professor Gola from the University of Waterloo. I'm going to do a live presentation today of a work which is joint with my graduate student Hao Tan on the topic of optimizing all-to-all data transmission in wide area networks. So I'm going to switch over to my slide deck now. The work I'm presenting was previously accepted to and presented at IEEE ICBC. And today I'm going to deliver a condensed version of this presentation. So Hao Tan was my master's student at the time when he conducted this research at the University of Waterloo, and he's currently my PhD student. If you have any questions that you would like to discuss offline, please take note of my email address, which is shown here on the title slide. Okay, here is the outline of the talk. I'm going to discuss the motivation for this work, then describe the theoretical contributions, and then describe the experimental contributions, and finish with concluding remarks. Okay, so replication is a very important problem that lies at the core of many of today's distributed systems, and this includes blockchains, payment networks, cryptocurrencies, as well as databases. And so it's very important that we do replication in an efficient way. In replication protocols, the dominant communication pattern and also the bottleneck is the all-to-all communication pattern, where every node attempts to transmit some data to every other node. Okay, so the complexity here is n squared. Everybody's talking to everybody, and this can very quickly overwhelm the network, and then we struggle to maintain high throughput and low latency. Within this problem, we're studying a very specific case, which is the case of the hose model. So in the hose model, we assume that there is a congestion-free core network and that the different nodes are attached to the core by edge links of a finite bandwidth or capacity, which here we denote as the uplink capacity and the downlink capacity. And so what makes the hose model unique is that we assume the bottleneck is at the edge and not in the core of the network. And this turns out to be a good fit for the networks that cloud providers use to connect their data centers. So anyone can communicate with anyone. The actual topology of the core network is irrelevant because we assume it's congestion-free. And what is relevant is the bandwidth restriction at the edge. In this kind of hose model, you can consider different ways of transmitting data. Now, we're going to take a step back here. Instead of all-to-all, we're going to look at a subproblem, which is one sender broadcasting to all the other nodes. So one way to do this is using a tree overlay, a one-level tree overlay, where the sender, in this case B, node B, has several blocks of data to send, and it sends them directly to all the recipients, so A, C, D, and E. And this is the most straightforward way to send the data, but it's not optimal in terms of the bandwidth. The uplink capacity of the edge link from B to the core here is divided into n-1 parts, where n is the number of participants, because we have to redundantly send a copy of the data stream to every destination. So while it's latency optimal, we only go across the core once, which we here call latency L. The bandwidth is lower by a factor of n-1 from the optimal, which is B. You can also route through a long path where B forwards to C, C forwards to D, D forwards to E, and so on. And with the participation of these other nodes, now the original sender, node B, is able to send its stream at full bandwidth, which here we assume is limited by the edge link. So that's going to be capital B. But now the latency is suboptimal because instead of every node receiving the data after one hop, it actually has to go through intermediate nodes. And so now in the worst case, the last node along this path, which is A, receives the data after n-1 times L latency. So it's bandwidth optimal, but it's not latency optimal. And turns out we can strike a compromise by routing with multiple overlays. And that in itself is not new, but it's how we optimize these overlays that makes up the contribution of the paper. So imagine that we split the stream into 4 substreams. And now for each substream, we can use a different overlay. For example, for substream number 1, B could send to C, and then C could forward the data to A, D, and E. And for this particular substream, we can get up to B bandwidth, so no bandwidth limitation there. And the latency is 2L, which is only twice as bad as what we know to be optimal. Okay, and so now the question is, how exactly should this overlay look to get a good balance of bandwidth and latency, or maybe to get the optimal bandwidth and then optimize latency as a secondary criterion. And then how do we do this when we have multiple substreams or partitions for each sender, and then finally when we have multiple senders. And so on to the theoretical contribution. What we prove is an interesting statement about what we call sustainable rates. So sustainable rates, as defined here, are the rates of the incoming data streams at the different sources. So we assume that each node in the network is receiving some client data, which is trying to broadcast to all the other sites. And our subscript I is the rate at which sender I would like to send. And we call these data rates sustainable if they meet some conditions which are necessary. So these rates cannot overwhelm the edge bandwidth and so on. There are 4 mathematical conditions which we can easily prove to be necessary. And if the rates meet these conditions, then we call them sustainable. And it is interesting that, as I will show in the next slide, these conditions are also sufficient. So if the rates are sustainable, what we would like to do is map each stream or each sender to some set of overlays. And that would then be how the different senders send data to the recipients. And what we prove in the theory part of this paper is that if the data rates are sustainable, then there is a way to partition these streams that and the mapping of the substreams to overlays, where not only are we able to transmit data at the required rate, but moreover, we can do it using relatively shallow overlays. And we call these relatively shallow overlays base overlays. This is what they look like. There are only 2 types that we need to make this result work. The type on the left, where the sender sends directly to the 3 recipients, is the traditional way to broadcast the data. And then the overlay on the right is where we go through a single intermediate node, which then forwards the data to all the remaining recipients. It turns out that some combination of these 2 overlays is sufficient to route the data through our hose model network, as long as the rates are sustainable. And this achieves latency of at most 2L. So it is at most twice the optimal value of L. Okay, and we have an optimization framework, which we call shallow forests, which does this for us. It first tries to maximize the throughput, and then when we have the optimal throughput, then it tries to minimize the latency. The solution to these 2 sub-problems is a little bit complicated, so I'm going to skip that, but it involves a lot of linear programming. So here we optimize for throughput, and then we can define some latency objective, and finally solve for the optimal latency weight. And in the remaining time, I'd like to discuss briefly the experimental results. So what we've done is taken one of the world's fastest consensus and state machine replication protocols, which is egalitarian Paxos. That's a third-party system. We modified it to allow the optimization and usage of these shallow overlays. And then we ran a stress test to see how fast we can send data in different workloads with our optimized overlays. So the experiment used 9 different EC2 regions in the Amazon cloud. And in this network, the cloud provider appears to restrict the uplink and downlink capacity to 750 megabits per second. ePaxos is implemented as actually a key value store. So we had a workload with write operations, 4 kilobytes each, and we used the Zipfian distribution to see what happens when a load is skewed. This is one of the most popular types of workloads that we see in the systems community in research papers. And this is what we found, that the original system, which is not quite shown here because it has some performance limitations, but the proxy for the baseline or the original is the red one. So it's our version of ePaxos, which we call aPaxos. And then the improvement is the blue, which is the optimized ePaxos with our shallow forest optimization. And what we see here in each of these graphs is a latency throughput trade-off. we want the throughput to be high and the latency to be low. So we want our curves to be as close to the bottom as possible and extend as far as possible to the right. The top left graph corresponds to uniform distribution, where we see that shallow forest is not making a difference. But as we increase the parameter S of the Zipfian distribution, that makes the workload more and more skewed, we see that the red curve starts to separate from the blue. And so the conclusion is that for skewed workloads, skewed meaning that some senders are sending a lot more data than others, there's a substantial difference in the latency and in the peak throughput between the unoptimized system and the system with a shallow forest overlay optimization. Conclusion, we have presented a technique for optimizing overlays in the hose model of the network. And at this point, I'm actually going to shut off the slideshow and speak to you directly. So we have this optimization technique for the hose model. We prove rigorously that shallow overlays, which have a worst case 2-hop latency, are sufficient to achieve the maximum bandwidth in this model. And we explain exactly how to achieve this maximum bandwidth, and as a secondary criterion, optimal latency using a linear programming formulation. And finally, in experiments, we demonstrate tangible speedups for skewed workloads in Amazon's cloud. And at this point, I will be happy to take questions. Okay, good. So I have a question from an anonymous, from the host. Question, do you know which mechanism different blockchains use to confirm transactions? Okay, transaction confirmation is a little bit different from replication. In many blockchains, the validation confirmation of transactions is done by a subset of the nodes. So that is not necessarily the all-to-all part that we would be trying to optimize. What we're trying to optimize is the part where the different nodes in the system are collectively trying to maintain a full copy of the blockchain, okay? So how would we apply this? Well, let's say in Bitcoin, according to some sources, we have somewhere in the neighborhood of about 9,000 to 10,000 of these so-called full nodes, which are validating the blockchain. So those nodes need to have a full copy of the blockchain. So those would be the recipients. Now, who would be the senders? Well, I suppose the blocks are being generated by the miners. Okay, so if it's not all to all, but maybe it's a case of many to many, we can still apply these optimization techniques. I'm not sure if this answers the question. If it doesn't, maybe we can shoot for a follow-up, which I would be happy to try to answer. Okay, I think we've exhausted all the questions, so I would be happy to catch up with the audience in Hopin. And also, if you took note of my email address at the beginning of this presentation, you can feel free to contact me directly. And my graduate student, Hao, and I would be happy to talk to you. So I'm going to sign off now. Thank you very much for attending, and I hope you enjoyed the talk. Bye.
Hello, everyone. My name is Zhou Li. I'm a professor in the Department of Computer and Information Science in the University of Oregon. I have, let me share my slide. So thank you for giving me this opportunity to talk about blockchain rewriting, how to make it fine-grained and accountable. Blockchain rewriting is necessary to correct illicit content stored in blockchain due to data protection laws, the requirements of data protection laws, such as General Data Protection Regulation, GDPR, in the Europe, and the California Customer Privacy Act, CCPA, in the US. These data protection laws allow customers to request a business to correct any personal information or delete any personal information collected from them. However, malicious rewriting of blockchain will violate the security guarantees provided by blockchain. Accountable blockchain rewriting is to ensure that blockchain can be used in broad applications without violating the data protection laws or reducing the security levels of blockchain. Blockchain rewriting can be achieved by replacing the standard hash function by the chameleon hash function. An ephemeral trapdoor can be added to the chameleon hash function so that the holder of ephemeral trapdoor can rewrite a transaction. In an earlier solution, to determine who can rewrite a transaction, the transaction owner may encrypt the ephemeral trapdoor using the public key of a modifier. The modifier can decrypt the ephemeral trapdoor using his or her private key, and then use the ephemeral trapdoor to rewrite a transaction without changing the transaction hash and just without break the link of a hash chain. Fine-grained blockchain rewriting means that the transaction owner uses a policy to encrypt the ephemeral trapdoor so that any user whose credential satisfies the policy can decrypt the ephemeral trapdoor and then use it to rewrite the data owner's transaction in blockchain. Our research effort is to make fine-grained blockchain rewriting accountable in the permissioned setting, such as Ripple and Hyperledger, as well as in the permissionless setting, such as Bitcoin and Ethereum. In fine-grained blockchain rewriting, the transaction owner creates a transaction with an access policy. Using the access policy to encrypt an ephemeral trapdoor of a chameleon hash function. A modifier owns attribute-based credential. If the credential satisfies the access policy, then the modifier can decrypt the ephemeral trapdoor and then use it to rewrite the transaction. The transaction level blockchain rewriting can be illustrated using this figure, where each block consists of a hash of the previous block, a set of transactions included in this block, the root hash of the transactions of this block, as well as a random number called nonce. In this figure, the H is a standard hash function such as SHA-256. The Merkle hash tree is the same as the one used in the immutable blockchain, except for some leaf node, the standard hash is computed on the communion hash instead of on the transaction itself for the immutable transaction. The communion hash, together with associated random number, are computed on the public key, the underlying transaction, as well as the access policy that determines who can rewrite or revise this transaction. A modifier with a rewriting privilege can find out a valid condition R prime for any revised transaction TX prime, so that the communion hash value remains unchanged. Therefore, the link of the hash chain is not broken due to the rewriting of the transaction. The blockchain rewriting can also be performed at a block level. In such case, the communion hash value is used to compute the transaction root instead of the transaction hash at the leaf nodes. The motivation of accountable blockchain rewriting is to thwart malicious rewriting of a blockchain. In the permissioned setting, our approach is based on traceable attribute-based access control. In our approach, attribute authority distributes attribute-based credential to transaction modifiers. If a modifier revises a mutable transaction, the modifier needs to sign it using a randomized signing key, so that any public user can verify the signature using the corresponding randomized verification key. However, the public user cannot recognize the modifier. The modifier remains anonymous. In the case of a malicious rewriting, given a modified transaction, the attribute authority can identify the modifier by linking the randomized verification key to the modifier's identity. In the permissionless setting, we cannot assume that there exists a centralized attribute authority who distributes rewriting privilege to modifiers. Our approach is based on decentralized, traceable, attribute-based access control. In our approach, the attribute authority is replaced by a dynamic committee. A threshold number of committee members will grant rewriting privilege to a modifier. If a modifier rewrites a mutable transaction, the modifier needs to sign it using a digital signature scheme. In the case of malicious rewriting, any public user can identify the modifier according to its signature, as well as the responsible committee that grants the modifier the rewriting privilege. By doing so, the modifier can be traced, can be identified and traced by the public user. And also the responsible committee can be identified. If you want to know more technical details, you may find out the technical details from this list of papers, including the blockchain rewriting, fine-grained blockchain rewriting, and accountable blockchain rewriting. Please feel free to contact me at the University of Oregon and my collaborator Yang Guangtian at the Singapore University of Technology and Design. Thank you for your time.
Thank you, Yingju. That was a fascinating presentation. And that's a wrap for our second day here at UBRI Connect 2020. We'll be back at 11:59 Pacific time. If you'd like to stay up with us late, we have a keynote with Chief Strategy Officer of CoinShares, Meltem Demirors, on securing financial networks, the future of finance, compute, and connectivity. We also have some technical presentations about mobile DLT challenges with Dr. Gujar, Stimulating Makers Black Thursday with Andrew Kirilov and Seyun Chung, and how strategic routing diminishes Lightning's anonymity with Satwik Prabhu Kumbal. Then we're going to be rerunning the PayID content with Ripple CTO David Schwartz and the demos that you saw, BitPay, Crypto.com, BitTrue, etc., for our Euro APAC partners. However, if you can't stay up late with us tonight, get your sleep and join us again at 6:59 a.m. Pacific time. See you soon. Take care.